Hi, everybody. Thanks for joining me here for part one of our discussion on financial markets. Now, financial markets are essentially intermediaries that allow us to transfer funds from savings to borrowers, and they help companies obtain financial resources required to meet a variety of business needs. Okay, so today most companies operate with some kind of revolving line of credit, and these lines of credits allow them to meet payroll, obtain resources, invest in new product development, and meet a variety of other business needs. Without financial markets, companies wouldn't have the access to cash that they need in order to do all of this. Okay. Now, depository institutions obtain funds by accepting checking and savings deposits and lending these funds out to borrowers. So, if you want to think about this in a practical sense, we'll think about a group of five people who each have $1,000 that they want to put into their savings. So, they each have $1,000, and then maybe we have a business that needs to borrow $2,500 for some type of venture. So the five individuals who have their $1,000 to save, they go to the bank and they deposit this $1,000, and the bank takes in a new $5,000. This gives the bank resources that they can then in turn loan out to the company that is looking for a loan. So the bank has $5,000 coming in from deposits. They loan out $2,500 to this business that is looking for a loan. In turn, what they end up doing is for the cost of loaning this money out, they charge the business interest. And then a portion of that interest often goes back to the depositors in the form of interest earned on their savings. Okay, now there are a couple different types of depository institutions that we're going to talk about here. First is a commercial bank, and this is the most common type of bank that we'll address. And they take savings deposits, they manage checking accounts, they do mortgage loans, they do business loans, and provide a variety of other banking types of services. Credit unions do similar things, but they are nonprofit cooperatives that are owned by their depositors. So in a credit union, you don't earn interest on your deposit per se, you earn dividends. They tend to have a little bit of a different objective in terms of what they're trying to achieve because they're trying to earn the best returns for their owners who are their customers essentially, whereas commercial banks have stockholders who they're trying to benefit. So credit unions will work to provide lower interest rates on loans to their members and higher interest rates on savings to their members than commercial banks will. Okay. And then the other component to credit unions is that often you need to have some type of affiliation to become members. So these affiliations are often tied to specific employers or industries or unions and things of that nature. So for example, when I was a teenager, I opened up a savings account with my local credit union, and I had access to it because both of my parents worked for schools, and both of the schools that they worked for had affiliations with the credit union that allowed employees' families to become members. Now, finally, we look at savings and loan associations. They accept savings and checking account deposits to make mortgage loans. Key differences between S&L associations and commercial banks are that S&Ls tend to be more local. They're often regulated by states as opposed to the federal government. And savings and loans associations also are more focused on providing loans to individuals as opposed to businesses. Now, as we look at non-depository types of financial institutions, there are institutional investors who take financial capital and use it to acquire a portfolio of different assets. So they will essentially try to develop a diverse portfolio that includes a variety of different stock holdings. Okay, securities brokers act as agents for investors who want to buy and sell financial securities. So for example, maybe you use Ameritrade to buy and sell stock. Ameritrade would be your security broker. And they charge you a fee every time they buy and sell for you. Now, a dealer participates directly in the markets, but they buy and sell for their own accounts. And what they're looking to do is they're looking to buy low and sell high. How they make their money is on the change of value in the securities that they're purchasing. So if a securities dealer, for example, may be following the airlines industry right now and looking for the stocks in the airlines industry to hit what they project to be the low value, will hold on to those stocks until the airlines industry rebounds, and then will turn around and sell, and the difference there will be how they make their money. And then investment banks specialize in helping firms raise financial capital by issuing securities. And what we mean by that is essentially they'll work with companies who are looking to sell shares of stock and things of that nature, looking to go public. And they'll either help them facilitate the sale of those shares of stock, or they may actually purchase the stock themselves. All right, so we have several laws governing financial markets, and we'll start with the Federal Reserve Act of 1913, and this is where the Fed was established as the central bank of the United States. So when you hear things like the Fed raised interest rates or the Fed lowered interest rates, or when we talked earlier in the semester about the Fed trying to control inflation, this is all based on the Federal Reserve Act of 1913. Then we look at the Banking Act of 1933. This established what we call the FDIC, or the Federal Deposit Insurance Corporation, to ensure that bank deposits are insured up to a specific value. So early on, they were insured up to $2,500. When I was a kid, they were insured up to $100,000. Today, they're insured up to $250,000. And the idea is that in order to help facilitate financial markets, the federal government has put some regulations in place to insure deposits, so that rather than keeping your money under your mattress, you might keep it where it's more secure in the form of a bank. Okay, and then by providing you with the security to put your money in the bank has the resources to provide loans and facilitate business growth. Okay. The Banking Act of 1933 also prohibited commercial banks from selling insurance or performing functions of investment banks. And the thought process behind this is that by prohibiting them from selling insurance or performing these other functions, what they did was they reduced the risk of the investments that banks were making, that commercial banks were making. So the federal government essentially said, if we're going to put into place a system where we insure the money that is placed in commercial banks, we're also going to put in place a system where commercial banks make less risky investments, so that insuring that money is less risky. Okay. The Securities Act of 1933, this required firms issuing new stock and a public offering to file a registration statement with the Securities Exchange Commission, or the SEC. It also basically said that companies couldn't defraud you when issuing stock, that they had to be honest in their disclosures. Okay. Then the Securities Exchange Act of 1934 established the SEC to regulate and oversee the securities industry. Moving on to the Financial Services Modernization Act of 1999. This overturned the section of the Banking Act of 1933 that prohibited commercial banks from selling insurance. It did not, however, overturn the creation of the FDIC. So after the Financial Services Modernization Act, we still had our deposits insured by the FDIC, but banks were allowed to take on more risky ventures. Sarbanes-Oxley Act of 2002, this has come up quite a few times in the course. This ensured that external auditors offer fair, unbiased opinions when they examine financial statements. And one of the ways that they do this is making sure external auditors don't have any affiliations with the companies that they're auditing. And then finally, we have the Frank-Dodd Act of 2010, and this expanded the Fed's regulatory authority over non-depository financial institutions. Prior to the Dodd-Frank Act, the Fed's authority was essentially over depository institutions such as commercial banks, S&Ls, and credit unions, but the Fed's scope expanded following the Frank-Dodd Act of 2010. So thanks for joining me here, and I hope you learned something, and we'll talk to you soon.